It's Friday morning just after 9 and your paycheck hits the account right on schedule. You can watch the deposit land in the app, and that same app in the same minute buzzes with a second notification. You've been charged $35 an overdraft fee. For what? For a $4 coffee you tapped the night before, hours before the money you were always going to be paid arrived in the account your bank had been holding the entire time. Sit with that sequence for a second. The bank had your direct deposit queued and knew to the dollar that the money was coming. It let a tiny purchase go through anyway, then billed you almost 9 times its value for the favor. That is not a glitch, and it is not bad luck. That is the product working exactly the way it was built to work. And to understand why you have to throw out the story you were told as a kid, that a bank is a safe place that simply keeps your money for you. When you deposit money, you're not renting a vault, you're handing the bank an interest-free loan. It takes your balance, lends it out to other people at 5, 6, 7%, and pockets the difference. That gap even has a name inside the industry: net interest margin. Your idle cash is the cheapest raw material the bank will ever get its hands on. And then having quietly profited from holding your money, it turns around and charges you for the relationship anyway. The first charge is the polite one, the monthly maintenance fee, usually $12 to $15, but notice how it gets waived. Keep a minimum balance parked in the account and the fee disappears. Read that again. You pay a fee just to keep your account open unless you agree to leave even more of your money sitting still and unspent, which is exactly the outcome the bank wanted in the first place. It's a leash sold to you as a discount. You think you're dodging a fee. You're actually agreeing to lend the bank a bigger, permanent, interest-free deposit and thanking it for the option. But maintenance fees are lunch money. The real engine is overdraft. For years, the average overdraft fee sat right around $35, and here's what makes it absurd once you do the math. The median overdraft covers a shortfall of about $50, and most people pay it back within 3 days the moment their next deposit clears. So you're being charged $35 to borrow $50 for 72 hours. No credit check, no application, no conversation. It is functionally one of the most expensive short-term loans in America, and people take it entirely by accident. The bank didn't lend you that money because you asked for a loan. It lent it to you precisely so it could bill you for it. And this is where the design turns from merely greedy to genuinely engineered. Imagine you have $100 in the account, and over one day you make 5 purchases: a $4 coffee, a $6 lunch, a $9 streaming renewal, an $11 pharmacy stop, and then a $90 tank of gas. Post them in the order you actually spent them: coffee, lunch, streaming, pharmacy, gas, and only the last one, the gas, tips you into the red. 1 overdraft, 1 fee. But for years, many banks refused to post them that way. Instead, they posted the largest charge first, dropped that $90 tank at the front of the line, and now every small purchase behind it lands in the negative. 1 overdraft becomes 4, same money, same day, same you, reordered by a computer to manufacture the maximum number of fees. And this isn't a theory. Wells Fargo did exactly this, and in 2010, a federal court ordered it to return $203 million to California customers, finding the bank had shuffled the sequence specifically to multiply what it could charge. And even that is just the appetizer. Many banks stack a second charge on top, a sustained or extended overdraft fee, another $25 or $35 simply for staying negative past 5 business days, 1 fee for going negative, another sustained fee 5 days later, 2 or 3 charges spawned from a single $4 coffee. So one small slip doesn't cost 1 fee, it compounds. People routinely end up owing more in penalties than they ever spent on money the bank pushed into their hands without ever once asking whether they wanted the loan. So why doesn't your brain catch any of this in the moment? 2 reasons. The first is mental accounting. You don't track money as a single running ledger the way the bank's computer does. You track it in buckets and feelings. I got paid, so I'm fine. And the bank's internal posting order lives in a place you were never shown and never think to look. The second reason is the framing, and it's the cleverest part of the whole machine. Back in 2010, regulators forced banks to ask permission before covering debit card overdrafts. So the bank sent friendly letters asking you to opt in, and they called it a courtesy, a service that spares you the embarrassment of a declined card. Would you like us to protect you? Yes, obviously, who says no to protection? Except the real alternative to that $35 courtesy was your card quietly saying, declined, and you paying nothing at all. They sold you the fee as a favor, and most of us said thank you. Now follow the money, because the scale is the whole reveal. In 2019, before the recent round of reforms, American banks collected $12.6 billion in overdraft and related fees in a single year, and it did not come from everyone evenly. This is the number that never makes the brochure. Roughly 9 out of every 100 accounts generate around 80% of all overdraft revenue, so this was never a safety net that occasionally catches a forgetful spender. It's a machine tuned to the people living closest to zero, and the ones for whom $35 is the gap between groceries and going without, and it bills them over and over. Convert that median $50 advance, repaid in 3 days, into an actual interest rate, and the effective APR lands near 17,000%. Yeah, there is no licensed payday lender in this country allowed to charge that. Your bank does, and files it under courtesy. Here's the part that proves it was always a choice. When the pressure finally came, the fees simply vanished. In 2022, Capital One eliminated overdraft fees entirely while still covering the transactions, and kept right on operating. Ali, Citi, and a wave of others followed. The regulator then proposed capping the fee at as little as $5 for the biggest banks, and the industry admitted, in effect, that $35 was never the cost of anything. It was a price set as high as customers would tolerate, a cost you can explain with paperwork. A price this far above cost is a decision made in a boardroom about you. So here's how you see it, and how you take the machine apart yourself. 1. Opt out of overdraft coverage entirely. At most banks, a declined card costs you nothing, and no turns out to be a feature, not a failure. 2. Ask your bank in writing whether it posts transactions in the order they actually happen or largest first. And if you get the wrong answer or no answer, move your money to one that posts chronologically or has dropped the fee for good. 3. Treat every minimum balance waiver as exactly what it is. Rent you're paying in idle cash so the bank can lend it out at a profit. Because if an institution earns money from holding your money and still charges you to hold your money, that was never a service you bought. It's a toll you never agreed to pay. The fee was never really about the coffee, it was about who controls the order of the ledger. Now you see it.